What's going on, everybody? Thank you so much for checking in. In this video, we're going to go over option contracts, and we're going to do so using the platform Robinhood. Now, if you're not comfortable using Robinhood or you prefer another platform, that's completely understandable. I'm only using Robinhood here to explain because it's so easy and beginner friendly. I find its interface to be very legible. If you want to use another platform, everything we teach you is going to apply to any platform out there. I personally use Thinkorswim by TD Ameritrade to make most of my trades. However, I do like to keep some change in Robinhood because I find it very user friendly. So let's go ahead and get started. Let's talk about what an option contract is. So an option contract has two sides. It has buyers and it has sellers. So any contract that you see in the world out there, if it's a contract to buy a house, if it's a contract to buy a car, it's going to have two sides. It's going to have buyers and sellers, and there's going to be some kind of regulation in between. So think of this SEC, or the Security and Exchange Commissions, to be the people regulating option contracts, and then there are people selling contracts and there are people buying contracts. For the purposes of this video, we're always going to be talking about the buying side, so don't worry too much about the selling side just yet. But just understand that buyers are the people who buy to open a contract, and the contract will stay active until two things. One, they can sell early and they can close out of the contract, or they can hold the contract until expiration. And if at expiration the contract is out of the money, and we'll explain what that means, then the contract will expire worthless. If it's in the money, then the contract will have some kind of value to it. But don't worry about that too much. We'll explain it in just a bit. Every contract has an expiration date. Most people are wondering, how long should I give a contract till expiration? That depends on if you're planning to day trade the stock or swing trade a stock. So if you're looking to buy and sell the same day, then your expiration could be sometime in the same week. It can even be the same day if you're trading contracts the same day expiration. But if you are swinging the contract, you generally want to give yourself a minimum of 2 weeks, assuming you're going to close it out within 2 to 3 days. So keep that in mind, and we'll go over that in more detail as the video progresses. Next, the Greeks. The Greeks are the bloodline of your contract. They break down how much you could make or lose intrinsically and extrinsically. We're going to explain the Greeks in such a way that you're never going to look back. You're going to be able to read them so easily going forward. Last but not least, we have intrinsic and extrinsic value. Intrinsic value is going to be the value of a contract at expiration if it is in the money. And we'll talk about what being in the money and out of the money means. Intrinsic value is the strike price minus the spot price, or the stock's price, so the underlying stock's spot price, and that will give you the intrinsic value, and we'll give you an example of this. Last but not least, we have the extrinsic value, which is your time value plus implied volatility. So we'll talk about time value and implied volatility momentarily. But just so you understand, so when we talk about an options premium, so anytime you hear us mention the word option premium, you're taking the intrinsic value and adding it to the extrinsic value, and that gives you the total premium, or the total price of the option contract. Now that can seem like a lot when we go over definitions, so for the second half of this video, we're going to apply everything we learned to actual real-life examples. So let's go ahead and pull up an option chain. We're going to do this on Apple stock. We're going to take a look at Apple, and we're going to go to Trade Apple Options. And so if you are not able to see this Trade Apple Options button, then you probably have to apply for options trading. You can do so under your settings. Any broker that you're using, they generally will want you to apply. That way you sign a few documents, because options trading does have a lot of rules, and they want to make sure that you know your stuff before they let you trade options. So let's go ahead and click on Trade Apple Options, and you're going to see a massive list that looks like this, and you're probably going to be a little overwhelmed. So for the purposes of this video, let's break down this entire page. First, let's talk about where we are. Apple buy call. So remember, for the purposes of this video, we're always going to be on the buying side. So when you see buy and sell at the top, you're going to stick to buy. Next, you're going to see call or put. So if you are thinking that this stock is going to go up, then you're going to buy calls. If you are looking at the stock and you think it's going to go down, then you're going to buy puts. Next, you have your expiration date. So right now it is January 2nd of 2023. If you want to buy an option contract, you can use any of these expiration dates, but just keep in mind that the further you go out, the more expensive that contract is going to be. Now, remember what we talked about here. We said intrinsic value and extrinsic value. The longer time you give yourself, the more time value or extrinsic value the stock's options are going to have. And the reason why is because expiration dates are going to be the point in which this option contract will finally expire. And so say, for example, you're looking at the stock, let's go back to Apple stock, and you're looking at it for the last month, and you think the stock has gone down a little too much, and you think that by the end of January, today is January 2nd, this stock is going to go back to $140. So you're going to go to its options chain, and you're going to take a look at calls, and you're going to go to the end of January, which is January 27th. That's the final and last expiration that options have for Apple in January. And you're going to go to the $140 strike price. So if you think Apple is going to go from $130 to $140 by the end of January, you're going to go to the January 27th $140 strike price, and then you're going to purchase this option contract. Now keep in mind, if you were to choose, for example, January 6th, so you see how this option contract is 1.72, and we'll explain how much this is. Say, for example, you go to January 6th, you're going to see that that same option, which is 140, is only 0.11. So notice that the price is significantly less, but that's because this contract expires this week versus this contract expires at the end of the month. So what does this mean for your premium? So the option premium is so much more expensive for January 27th because now you have about 25 more trading days in order for the stock to reach your premium that you're looking at. So remember, the entire idea of an option contract is you want to eventually have that contract move to something called being in the money. So when we do break down options for Apple's chain, you can see that there's a significant point in which they split. And this split defines contracts that are out of the money and contracts that are in the money. So for example, Apple's price right now is $129.97. That means every contract $129 or less is going to be in the money, and it's only going to get more and more expensive to get into these contracts. The reason why is because at expiration, remember, for a contract to have any value at expiration, there needs to be an intrinsic value. So for example, if Apple was to expire today, say for example, this expiration date was today, January 2nd, and we take this, which is 6.45, which is multiplied by 100, so it's actually 645, and we'll talk about why it's multiplied by 100 in just a second. So you take this, so you're going to take 645 and you're going to subtract it from the share price. So if you take 645 minus 130, that price is going to be the intrinsic value if that contract expired today. So if you were a buyer of this option and today's the expiration date, you're going to subtract the spot price from this, and that's going to give you the value that you have left over if you choose to collect the premium of your option. Now, the reason why this is so much more expensive is because of two things. You have, first, the longer expiration. So you have about 25 days worth of value in this contract that's coming from the extrinsic value. And you have implied volatility. Implied volatility is a percentage. The percentage here is 40%. Implied volatility is the expected move that the market expects from this stock for this specific option. So if a stock has a high implied volatility, that means there is a higher chance that this stock is going to swing into being in the money rather than out of the money. And the higher that chance is, the more value a contract is going to have. Now keep this in mind. We're not going to get into implied volatility too much, but keep this in mind. You want to buy contracts that have less than 50% in implied volatility percentage. If you buy contracts that have a 100 or 120% implied volatility percentage, you are likely paying too much for that premium. And that usually happens right before a major announcement or an earnings statement for a stock. So remember, when you are trading contracts, the market is looking at the projected move of a stock to measure the implied volatility. So a company that's reporting earnings tomorrow, Earnings can move a stock by double-digit percentage points easily, up or down. So if there's a expectation that the stock will move double-digit percentage points tomorrow, then the implied volatility is going to be much higher on those option contracts. So keep that in mind when you're trading. So this contract's value is 645 versus, if we compare it to the January 6 in the money contract, it's only 310. So you see that it's worth less than half of it because the stock's option has much less time in order to expire. So here you're looking at 5 days or 4 days till expiration. Here you're looking at 25 days till expiration. So let's jump back into the January 27th 140 contract. So we are looking at Apple, and we expect Apple to go to 140 by the end of January. So January 27th, we look at these contracts. The next thing we have to look at is the Greeks. Do we like the Greeks on this expiration? So the Greeks are down here, and we're going to break this down to you so simply. But before we do so, let's talk about why we multiply the ask price by 100. The reason why we multiply that price by 100 is because every contract, bear with me now, every contract guarantees the buyer 100 shares of the underlying stock at expiration. So this is where we start to break down what are option contracts. Why are we even trading these contracts? So what you're doing as a buyer of an option contract, so say we already talked about Apple currently being 130. Say you are very bullish on Apple and you think that Apple's actually going to go to 160 by the end of the month. So for that, you say, okay, I'm going to buy the 140 strike, and if by the end of the month Apple is trading at 160, what this contract guarantees you at expiration, so January 27th, anytime between now and January 27th, if you buy this contract and Apple even jumps to $200, now you are guaranteed, because you bought this contract, you are guaranteed 100 shares. It's always 100 shares. 95% of the time, it's your contract is guaranteed you 100 shares at $140. Even if you buy this contract and by the end of this week, Apple is trading at $200. Say, for example, Apple is trading at 160 by the end of this week, and you bought this contract, you can then exercise your contract option. So you exercise to buy it, and you are guaranteed 100 shares of Apple at 140. And what does that give you? That automatically places you at $20 in profit per share. So remember, at this point, theoretically speaking, you bought this contract, it's the end of this week, Apple is trading at 160, and you have a strike price at 140. So you exercise your contract, and now you guaranteed yourself $20 profit per share times 100. So you are up $200 times 100, so the $2,000 profit just because you had this contract. Now, the purpose of options trading is not necessarily to hold a contract until expiration or even until your strike price hits. Just because you buy an option contract, it doesn't mean you can't close it at an earlier point. So here's our approach to trading options, and this is usually how we buy and sell them. We think Apple's going to go up. We buy the 140 strike. Apple goes up, and as soon as Apple goes up, for every dollar that it goes up, this contract that you hold will add value, so the premium will go up. So say, for example, we buy Apple's 140 strike at 172. Within just a few hours, Apple moves up by $3. So now we are $3 further to being in the money. So remember, the goal is for the option to go move into the money. So say we buy at 140, the stock moves $3 to being in the money. Now we're going to be making roughly $24 per dollar that the stock goes up. So for every dollar that Apple goes up, we're going to add $24 worth of premium to our option contract. Where did I get this $24 from? I got it from the Greeks. So this is where it leads us to explaining the Greeks. Before we do so, please make sure you hit the subscribe button and give us a thumbs up if you like what you see. We're really trying to grow, and it would mean a ton if you were to support us. So back to the Greeks. We have delta, which is going to be how much you're going to make or lose per dollar that the stock goes up or down. Gamma is for every second dollar. So if a stock goes up $1, so say Apple, we bought this 140 strike and we are trying to figure out how much are we going to make if Apple goes up by just $1. We will make $23 or $24, give or take, because we multiply this number by 100. So you're always going to take the Greek number, so delta, and multiply it by 100. Delta will give you how much you're going to make per dollar that the stock goes up. Gamma will tell you how much you're going to make per every second dollar. So say on the first dollar you make 24. On the second dollar you'll make 24 plus 24 because that's the first and second dollar plus gamma. So you made 24 plus around $2. So you made here $50 because you're taking this number and adding it to this number on the second dollar. Now theta is always going to be a negative number because theta is part of your extrinsic value. Extrinsic value is your time value. So remember, every day that you hold this contract, you are losing time value because you're getting closer and closer to your expiration. So say you hold this contract until tomorrow and Apple doesn't even move. Apple opens at 129.97 and closes at 129.97 tomorrow. You just lost around $8 just by holding the stock one day, the option contract for the stock one day. And that's because theta, which is time decay, is always working against you if you are a buyer of an option contract. Every day that you hold every day that you hold an option contract, you're going to be losing your theta. And every day that you get closer to expiration, that theta will likely go up. Not all stocks will have the same kind of theta movement. Different stocks will have different option Greeks. So keep in mind, I'm showing you Apple's contract. Apple has phenomenal Greeks. However, there are companies out there that don't have such good Greeks, and you're not going to find such good options on them. So last but not least, let's go ahead and break down the bid and the ask. If you are trading contracts, there is something that you need to understand, and that is the bid and the ask number. You always want to find contracts that have generally close numbers when it comes to the bid and ask. The bid is the amount of buyers trying to buy the option at this price, and the ask is the amount of sellers that are trying to sell it at this price. If there is a too far of a disagreement between the buyers and sellers, that means this contract does not have a happy medium price, and you're going to want to be careful when you're getting filled. So for example, when I go to buy this option, say I want to buy this option, I want to make sure to edit. So I want to buy one share, so one contract, which guarantees me 100 shares. And now my limit price is going to be between 145 and 172. So the buyers are willing to pay a max price of 145 and the sellers are willing to sell for a minimum price of 172. What does that mean for me? That means I want to be somewhere in the middle. So there's about $25, $27 in difference between these two. So I would try to put my strike or my purchase price at 155 and try to get filled right around that range. So the reason I'm explaining the bid and ask, and I'm going to be sealing off the video with this, is because if you buy a contract and you don't set a limit price, the broker that you're using is always going to fill you closer to the ask. So have you ever gotten into a contract and you're negative right away? That's because you got filled too high on the limit price. So you got filled somewhere closer to 172 versus the bid of 145, which means you're already paid too high of a premium. So you always want to try to get closer fill to the bid rather than the ask. And keep in mind, Robinhood and the smaller time beginner platforms, they're not too friendly when it comes to getting you filled near the bid. If you use a platform like Thinkorswim, they're a lot more smoother with trying to get you filled near the bid rather than the ask. But keep in mind, this is also strictly for buying the contract. On the flip side, when you go to sell a contract, you want to be closer to the ask. So for example, let me go try to close this contract. Here I got into Meta and I got in at an average cost of 166 per contract. The contracts are now trading around 176. So I'm up around 6% on this contract. And if I go to collect profits, I'm going to go to sell. I'm going to put my limit price closer to the ask price because I'm already in this contract. So I'm not bidding for it, I'm asking for it. So I'm asking somebody to buy it from me and I want to get filled closer to the ask. So what I'll do is I'll go here and I'll click 178, which is close to the ask. I'll review order and I'll sell it at 178. If it doesn't get filled, if nobody wants to buy it at 178 and I kind of want to get rid of it, what I'll do is I'll go back and I'll resubmit it maybe at 177 or at 176. Just try to get filled as close to the ask as possible. That way you don't sell the contract for too little closer to the bid. Alright guys, so thank you so much for sticking around. That was just a brief explanation of options and how to read an options chain. If you like what you saw, please give us a thumbs up and don't forget to subscribe.